House prices have been surging across the world since the lockdowns of 2020 and are growing at unsustainable rates, far above the rate of income growth. Prices must fall. It's simply a question of when and by how much. So in this video, we drill into the drivers behind house price growth to see where we stand, how bad things could get, but also look ahead for the US and UK markets to see where prices could be headed. So let's look at house prices in a bit more detail. We can see the nature of the problem if we look at prices across various US cities before the pandemic recession, that's this vertical blue shaded region, and then after it. Just see how the gradients suddenly switch into overdrive after that recession. Cities like Phoenix, Las Vegas, Miami, and Dallas are simply surging upwards in prices. And if we look across the US as a whole, you can see that if we look at these periods between recessions, the growth rate in house prices varies quite markedly. For example, up to 1990, the growth rate was about 5.6%, then 4%, then 6.6%, then 3.4% after the global financial crisis. But recently, the growth rate has gone to simply unprecedented rates of growth of 18% per year. The reason why that's unsustainable is that over the long term, house prices track income growth. So the price to income ratio generally snaps back to its long-term average. So if we look at Australia, Canada, the UK, and the US, based on these price to income ratios, they're pushing all-time highs. Australia and Canada have simply gone to levels that we've never seen before, and the UK and the US are pushing all-time highs. So if ultimately we do get mean reversion in prices back to this kind of long-term average, then we would expect a correction at some point. Unfortunately, we don't know when that's going to be, but we can be confident that it will happen. If prices do fall, it's not necessarily a problem as long as you're willing to stay in a property for a long period of time. But if you do buy at the top of the market, how long might you be left in a situation of negative equity? For the US, Robert Shiller's published housing data for average house prices going back to before 1900. And what we can do is look to see how long the US market, on average, has stayed below its previous all-time high, and then how long it's taken to recover to that previous all-time high. Now, the worst period of drawdown for US house prices was this 18-year period spanning the Great Depression. That lasted from 1926 to 1944. Another terrible period was even earlier, so that was an 11-year drawdown that lasted between 1895 and 1906. But then in recent memory, we've got the period after the global financial crisis, when it took 10 years for house prices to recover to their pre-financial crisis levels. That ran from 2006 until 2017, and the peak to trough fall during that sell-off was just under 30%. In the UK, I've got nationwide house price data, which only goes back to 1950, but here again you can see that there were some fairly severe sell-offs and a fairly long recovery time from those sell-offs. The worst was in the 1990s, so that ran from 1990 to 1998, an 8-year period. So if you were unlucky and bought right at the top of the market, it would have taken 8 years to get back to the previous price you bought at. Then more recently, there was a 7-year drawdown period when the peak to trough fall was about 20%. Now, given the level of price to income ratios right now, it's quite feasible that we could get another 7, 8, 10-year drawdown period. So if you are unlucky enough to have bought at the top of the market, you might be in a situation where you have negative equity. And remember, that's often levered. So you borrowed money to buy the house, and so you'll actually lose more money than you put into the deposit for the house in the first place. So you may be locked into the property for a long period of time. However, if you are willing to stay in the property for a very long period of time, then this isn't a problem. Now let's run through the factors which drive house prices, and we can start with inflation. The reason why this is a negative factor is that inflation takes money out of our pockets. We're paying more to buy things like energy and food, so we have less household disposable income, and banks usually lend against that disposable income. So if that falls, we can borrow less, and that makes houses less affordable. And if we look at inflation right now, you can see that it's pushed up to multi-decade highs. We're above 9% in the UK, and in the US. So that's definitely a negative factor. One consequence of higher inflation is rising interest rates. The reason for those rising interest rates is that central banks are raising interest rates to stave off high inflation. This is their primary policy tool. Now, after the global financial crisis in 2009, you can see that interest rates were pretty much at zero across much of the developed world for over a decade. Then they started to raise interest rates leading into the pandemic. Then they cut interest rates to zero in 2020 to stave off the negative effects of the pandemic. Then we got the surging inflation in 2022 across much of the developed world, and almost all of the central banks have now started to sharply increase their interest rates. That's true in the UK, Australia, Canada, and the US, and it's likely to continue for some time to come. The only exceptions are the Euro area and Japan. Now, the reason why that matters for the housing market is that your mortgage interest rate is set to be a little bit above the central bank policy rate. So what I've shown here in this graph is the funding cost, the interest rate for mortgages, depending on how much of the percentage of the value of the house you're borrowing, ranging from 60% loan to value up to 95% loan to value, which has the highest interest rate. Notice how sharply those rates have increased since the beginning of 2022. That means that it's going to cost more to fund your mortgage, and people will be able to borrow less because their debt servicing costs will be that much higher. So while in the UK we fix mortgages for a shorter period of time, in the US they can fix mortgages for a 30-year period. And the blue line here shows the borrowing rate for those 30-year mortgages going back to the 1970s. Underneath that is the central bank policy rate. Notice how the two kind of track each other downwards over time, but that recently they've been moving in the opposite direction. The Fed's been raising interest rates very sharply, and mortgage rates have risen sharply as well. And if we convert that 30-year borrowing rate into a monthly payment, and we do that by working out the average price of houses sold, you can see that the surge in house prices combined at the same time with a higher borrowing cost has made the monthly servicing cost for that debt surge at an incredible rate. So over the course of 2022, we've gone from a median cost of servicing debt of below $1,500 a month to something which is almost double that at about $2,500 a month. So it's almost certain that that's going to have a cooling effect on house prices. Another negative factor is slowing real wage growth. Let's start with the UK, and here on a log scale I've shown average weekly earnings going back to 2000. You can see that the rate of growth splits quite cleanly into two phases. The first one is between 2000 and 2008, where nominal growth, that's not adjusted for inflation, was about 4%, and real growth, where you do adjust for inflation, was about half of that. However, after 2008, you can see that growth slows dramatically. Nominal growth halves to about 2.3%, and real growth, adjusted for inflation, is very close to zero. The reason why this matters is that the sustainable rate of house price growth is driven by wage growth. So in the UK, that would be a rate of growth of just over 2%, or if you want to adjust for inflation, roughly flat, i.e. no growth at all. If we look at the United States, and here we're looking at the real average hourly earnings, the real growth rate is comparable to the UK. That's a growth rate of about 0.5%. Nominal growth, where you don't adjust for inflation, is just under 3%. But what's worrying is that real growth has recently fallen off a cliff. That's because wages are not keeping up with inflation. But assuming that we have the average growth rate since 2006 for wages, which is just under 3%, that would be the sustainable house price growth rate. Now that's much lower than the actual observed house price growth rates that we've seen. That's why the price to income ratios have been steadily rising. Lockdowns turned out to be a great way of saving money, but it seems as if those savings are now running out. So if we look at the US personal savings rate, that's how much money people save every month as a percentage of their disposable income. Notice how it surged to unprecedented levels in 2020. But then as the economy opened up and people could go out and spend their money, that savings rate dropped back to levels below where it was before the pandemic. Now, some people use those savings for a bigger deposit for their houses, but now it seems that that money's being exhausted and that'll no longer be the case. However, not everything is negative. For example, supply remains low. So if we look at data from Redfin in the United States, you can see that the supply compared to, say, 2012, so this is the number of homes which are available for sale, is very low. So while demand remains, that tends to underpin house prices, which probably explains the resilience we've seen so far. Similarly, in the UK, supply remains limited. For example, if you look at the Royal Institute for Chartered Surveyors, and this survey shows that despite the softening in demand at the headline level, tight supply conditions have underpinned house prices. So just as for the US, you can see that supply compared to, say, 2000 up to 2008 remains very low. Another positive factor is low and falling unemployment. That's positive for housing because if you can just walk into another job, you'll be more confident about buying houses and also able to fund the purchase of a house. And the spike in unemployment which we got with the pandemic is long over in the US, and with unemployment at 3.6%, that's as low as it's been for the last 50 years. And it's not just the US where unemployment is low, that's true across much of the developed world. So you can see that unemployment rates in Canada, Australia, the UK, as well as the US, are low and also falling. Now, before we move on to the cracks which are starting to appear in the housing market, but also our forecast for the UK and the US, let me quickly mention our membership. We run it on our website, PensionCraft.com, and you get access to all kinds of goodies, like access to Slack, where you can ask a question whenever you like. Also, you get access to lots of members-only videos. To learn more about that, just click on the link beside me and in the description beneath me. While we've yet to see house price falls, we are starting to see signs of weakness. In the UK, for example, if we look at the Royal Institute for Chartered Surveyors, they publish monthly data, and one of their leading indicators is the number of new buyer inquiries. That's fallen very sharply recently, which is a sign of weakness in prices ahead. For example, this fell very sharply in 2006 before prices started to fall. And in the US, we have data from the National Association of Realtors, which is the number of existing home sales. That's reached a level in June, which was the lowest it's been since June of 2020, and it was well below market forecasts. And perhaps more worryingly, the number of houses where the price had to be cut for a sale has surged in recent months. That's currently the highest it's been since Redfin started recording this data in 2015. Now, if we look at the median sale price from Redfin, you can see that it's very seasonal. So here were the prices in 2020, in 2021, and in 2022, we've seen the usual surge between February and July. But what seems to have happened over the previous month is a softening in prices. That's still very early days, but it does look worrying. So let's put it all together and try to come up with a forecast for the UK and for the US. Now, our approach here is very simple. Remember that the price to sales ratio is mean reverting. It snaps back to its long-term average, whereas wages trend upwards over time. So in this top panel, you can see UK wages going back over the last 30 years. So what we can do is extrapolate that trend with a central case, a best case, and a worst case. That would be percentage growth over the next few years of 1.5% for our central case, 2.2% for our best case, and 0.8% for our worst case. And we do something similar for the price to income ratio. Our central case is that we get slight mean reversion to 6.8 times. That would still be very high by historic standards. The best case is that we throw caution to the wind and price to income ratios surge upwards to 8.3 times. And our worst case is that we get mean reversion to 5.4 times. And to get our forecast, we just multiply those numbers together. The price to income ratio multiplied by the income. Now, the central case is that there's really not much growth at all over the next 3 years. There's a growth of just 0.9% in house prices. The best case is growth of 6%. That's if we get a combination of the best of both worlds. Very rapid income growth combined with price to income ratios which surge upwards. And then the worst case is where we get low wage growth combined with a reverting price to income multiple. And there we'd get a fall of 5% per year over the next 3 years. So certainly not catastrophic, but if you are buying at the top of the market, you could be facing negative equity. Now let's look at the US. And here the wage growth is stronger, so the central case is 2.5%. The best case is a very brisk 3.4% growth in income, and the worst case 1.7%. And the price to income multiples, the central case is 9.1 times, which is still high by historic standards. The throw caution to the wind scenario is 10.7 times. And if we get mean reversion, we expect it to go down to 7.6 times. Multiply the two together, and our central case is growth of about 2% over the next 3 years, with the best case of 6.1%, and in the worst case, falls of about 3% per year for the next 3 years. So low unemployment combined with a lack of supply have underpinned prices so far, but eventually what's going to win this tug of war is going to be very rapidly surging mortgage rates. That's going to make funding mortgages more expensive, and we're also seeing very high inflation and falling real wages. That's got to put a brake on house prices in the not too distant future. Now, don't forget our offer. If you want to join our membership, it's at PensionCraft.com, and there'll be more about that in the link beside me and in the description beneath me. And as always, thank you for listening.